Imagine spending 40 years doing everything right. You saved. You sacrificed. You maxed out your 401k every single year, skipped vacations, drove the same car for a decade longer than you wanted to. And then, the moment you turn 73, the government sends you a letter that says you now have to withdraw money whether you want to or not. If you get the math wrong, you could lose up to 25% of that money in penalties alone. Most Americans have never even heard of this rule until it's already too late to plan around it. It's called the Required Minimum Distribution, or RMD, and it quietly controls the financial future of nearly every retiree in this country. It decides how much tax you'll pay in retirement. It can push you into a higher tax bracket the year you least expect it. It can even raise your Medicare premiums without you ever seeing it coming. And yet, almost nobody talks about it until the letter shows up in the mailbox. Today, we're breaking down exactly what RMDs are, why they exist, how they're actually calculated, and the mistakes that cost retirees thousands of dollars every single year. By the end of this video, you'll understand something that most financial advisors charge hundreds of dollars an hour to explain, and you'll know exactly how to avoid the traps that catch millions of Americans off guard every single year. Because here's the truth nobody tells you when you open that first retirement account. The government let you save tax-free for decades. But nothing stays free forever. Eventually, they want their share. And RMDs are how they collect it, whether you're ready or not. Let's start from the very beginning, because understanding this properly changes everything. When you put money into a traditional 401k or a traditional IRA, you get a tax break the moment you contribute. That dollar you put in today doesn't get taxed today. It grows for decades without the IRS touching it. That's the entire appeal of these accounts. It feels like free money, like the government simply forgot to collect its share. But it was never actually free. It was deferred, delayed, postponed until a date the government chooses, not you. Think of the IRS as a patient business partner in your retirement account. They let your money grow untouched for 30, 40, even 50 years, compounding quietly in the background. But they always intended to collect their share eventually. Required minimum distributions are how they make sure that happens. Because without a rule like this, some retirees could theoretically leave that money growing tax-free forever, passing it down for generations, and the IRS would never see a single dollar of it. So the law says something simple but powerful. Once you hit a certain age, you have to start pulling money out. Not because you need it, not because you asked for it, because the rules say so, and the penalty for ignoring them is steep. As of current law, that age is 73. It's scheduled to rise to 75 in the coming years as part of recent retirement legislation. But for most people retiring right now, 73 is the number that actually matters. Here's where things get interesting, though. A lot of people assume RMDs only apply to a 401k sitting somewhere from an old job. That's not true, and this misunderstanding causes real problems. RMDs apply to traditional IRAs, SEP IRAs, simple IRAs, and most employer retirement plans, including old 403b accounts from teaching jobs and government positions. If the money grew tax-deferred, the IRS eventually wants their cut of it. Roth IRAs are the major exception to this entire rule. Because you already paid taxes on that money before you ever put it in, the IRS has no reason to force withdrawals during your lifetime. That single difference is one of the most underrated planning tools in all of personal finance, and we're going to come back to exactly why later in this video. Now let's talk about how the government actually calculates how much you're forced to withdraw each year. Because this is where most retirees get confused and where the real financial mistakes begin to happen. The formula isn't as complicated as it sounds once you break it down. The IRS looks at your account balance as of December 31st of the previous year. Then they divide that number by a life expectancy factor pulled from an official IRS table based on your current age. So if you're 75 years old and your factor from that table is roughly 24.6, and your account balance was $500,000, your required withdrawal for that year comes out to about $20,000. That money doesn't disappear into thin air. It simply moves from a tax-deferred account into your regular bank account, and the moment it moves, It becomes taxable income for that year, no different than a paycheck. Here's the part most people don't realize until it actually happens to them. That withdrawal counts as ordinary income. It stacks directly on top of your Social Security benefits, your pension, and any other income you have that year. And that stacking effect can quietly push you into a higher tax bracket than you ever expected to be in during retirement. Let's look at a real example to make this concrete. A retired teacher we'll call Linda spent her entire career contributing steadily to a 403b, which works almost identically to a 401k. By the time she turned 73, her account had grown to just over $600,000 through decades of consistent contributions and market growth. Her required withdrawal that first year was around $23,000. On its own, that number doesn't sound dangerous at all. But combined with her Social Security benefits and a small pension from her school district, it pushed her into a higher tax bracket than she had planned for. She ended up paying several $1,000s more in federal taxes than she expected. And it also triggered something called RMD, an income-related surcharge on Medicare premiums that most retirees have genuinely never heard of until it shows up on their bill. Linda didn't do anything wrong. She wasn't reckless. She simply didn't know this rule existed until it quietly reshaped her tax return. This is the hidden truth about RMDs that almost nobody explains clearly. They aren't just a withdrawal requirement sitting in the background of your account. They're a tax trigger. And if you don't plan for them years in advance, they can cost you thousands of dollars you never even saw coming. But this is where things get even more serious, because the penalty for getting this wrong is one of the harshest in the entire tax code. If you fail to take your RMD, or you take out less than what's required, the government doesn't send a gentle reminder. For years, missing your RMD meant a 50% penalty on the amount you should have withdrawn. Recent law changes have lowered that penalty to 25%, and it can drop further to 10% if you correct the mistake quickly. But even at the reduced rate, this remains one of the single most expensive mistakes you can make anywhere in retirement planning. Picture this scenario. You're supposed to withdraw $15,000 for the year, but life gets busy, or it's simply your first year subject to the rule and nobody reminded you. If you don't fix it in time, you could owe thousands of dollars in penalties stacked directly on top of the taxes you already owe, all because of a form you didn't know you had to fill out, or a deadline nobody warned you about. Most people don't realize how strict the IRS actually is about this deadline. Your very first RMD gives you a small grace period, allowing you to delay until April 1st of the following year. But every RMD after that must be taken by December 31st, no exceptions. And here's the trap that catches so many retirees off guard. If you delay your first withdrawal into that grace period, you end up taking 2 RMDs within the same calendar year, which can dramatically spike your taxable income and push you into a much higher bracket than you ever anticipated. This is one of the most common and costly mistakes retirees make, and almost nobody warns them about it in advance. Not even well-meaning family members who assume retirement finances just take care of themselves. So how do smart, informed retirees actually plan around all of this? The biggest mistake comes next, and it's one most people never even think about until it's already too late to fix. Many retirees wait until age 73 to think about RMDs at all. But the real planning window opens the moment you retire, often a full decade earlier than most people realize. Because once your income drops in early retirement, before RMDs begin and before Social Security kicks in, you're often sitting in one of the lowest tax brackets you'll ever see again for the rest of your life. This is the window where strategic retirees convert portions of their traditional IRA into a Roth IRA. Yes, you pay tax on the amount you convert, but you pay it now at a lower rate while your income is temporarily low. And once that money sits inside a Roth account, it grows completely tax-free from that point forward and is never subject to RMDs during your lifetime. Think of it like moving your money out of a house the IRS still owns a piece of and into a house that belongs entirely to you. It costs something upfront to make that move, but it removes the government's future claim on that money permanently for the rest of your life. This single strategy has saved retirees tens of thousands of dollars in lifetime taxes. But it only works if you plan years before your RMDs actually begin, not after the letter arrives. Here's another strategy that genuinely surprises a lot of people the first time they hear it. If you're charitably inclined, the IRS allows something called a Qualified Charitable Distribution. This lets you send your RMD, or a portion of it, directly to a qualified charity instead of into your bank account. That amount doesn't count as taxable income at all. It satisfies your RMD requirement completely, without increasing your tax bill or your Medicare premiums in any way. For retirees who already give to causes they care about, this single strategy can be one of the most efficient tax moves available anywhere in the entire tax code, and most people have simply never heard of it until it's explained to them directly. Now let's talk about a myth that trips up a surprising number of retirees. Many assume that once they take their RMD from one account, that's the end of it for the year. But if you have multiple IRAs spread across different institutions, the rules get more complicated than most people expect. You can add up the RMDs owed from all your traditional IRAs and withdraw the total amount from just one of them if you choose. But 401k accounts don't follow that same flexibility. Each individual 401k requires its own separate withdrawal, calculated and taken on its own. Mixing these two systems up is one of the most common paperwork mistakes retirees make every year, and it can trigger the very penalty we talked about earlier in this video, simply through confusion rather than negligence. This is exactly why so many retirees end up working with a financial advisor or a tax professional the year their RMDs officially begin. Not because the math itself is impossible to understand, but because one small mistake, inside a system this rigid and this unforgiving, can quietly cost real money that's difficult to get back. There's one more piece of this puzzle that almost never gets mentioned, and it has to do with where you actually live. State taxes on RMDs vary enormously across the country, and this single factor can quietly change your entire retirement math. Some states, like Florida, Texas, and Nevada, don't tax retirement income at all, which means your RMD withdrawal only faces federal tax. Other states tax retirement withdrawals just like ordinary income, stacking another layer of cost on top of what the federal government already takes. This is why some retirees choose to relocate in the years leading up to their RMDs, not just for weather or lifestyle, but because the tax difference over 20 or 30 years of withdrawals can add up to a genuinely significant amount of money. It's rarely the deciding factor on its own, but it's a piece of the puzzle that almost nobody considers until someone points it out to them directly. Let's talk about one more real scenario, because seeing how this plays out for an actual couple makes the stakes much clearer than numbers on a page ever could. Consider a retired couple we'll call Mark and Susan. Mark had a substantial 401k from a long engineering career, while Susan had a smaller IRA from years of part-time consulting work. When Mark turned 73, his RMD alone came out to nearly $40,000 for the year. Combined with Susan's smaller RMD, their Social Security benefits, and a modest pension, their household income jumped significantly higher than it had been the year before. That jump pushed them into a tax bracket they hadn't experienced since Mark was still working full-time. It also triggered higher Medicare premiums for both of them simultaneously, since IRMA surcharges are based on household income, not individual income. What should have felt like a comfortable, well-earned retirement suddenly came with a tax bill that caught them completely off guard. Here's the lesson buried inside their story. RMDs don't just affect individuals. They affect entire households, and married couples often get hit twice as hard because two separate accounts, two separate withdrawals, and two sets of Social Security benefits all land in the same tax return at the exact same time. Couples who understand this ahead of time sometimes stagger their Roth conversions between spouses or time large withdrawals in different years, specifically to avoid stacking everything into one expensive tax season. It's a small adjustment that requires foresight, but it can meaningfully change how much of their own money they actually keep. Let's step back for a moment and think about why this topic matters so much right now, in this exact moment in American financial history. More Americans are retiring today than at almost any other point in history. The baby boomer generation is moving through retirement in massive numbers, year after year, and trillions of dollars currently sit inside tax-deferred retirement accounts across the country. RMDs aren't a small technical detail buried in the tax code anymore. They're becoming one of the biggest tax events in the average American's entire financial life. And the rules keep shifting under everyone's feet. The starting age has moved from 70 and a half to 72, and now to 73, with 75 already on the horizon for younger retirees. Congress has been actively rewriting these regulations in recent years, which means the retirees who stay informed are the ones who consistently end up keeping more of their own hard-earned money. This is the part that most people miss entirely, and it's worth repeating clearly. RMDs aren't just about following a government rule. They're about controlling something you actually have real power over, your taxable income, during the only years of your life when you genuinely have the flexibility to shape it. Before retirement, your income is largely dictated by your job and your employer's schedule. After RMDs begin, much of your income is dictated by a formula you don't control. But in between those two stages, in that quiet window of early retirement, you have more control over your own tax bill than at almost any other point in your entire financial life. Most people simply don't realize that window exists until it has already quietly closed behind them. So here's what you actually need to remember from everything we've covered today. Required minimum distributions force withdrawals from tax-deferred retirement accounts starting at age 73 under current law. The amount is calculated using your account balance and an official IRS life expectancy factor. Every dollar withdrawn counts as taxable income, and it can push you into a higher bracket or increase your Medicare premiums if you're not careful about planning ahead. Missing an RMD triggers a steep penalty, as high as 25% of the amount you should have withdrawn that year. Roth IRAs remain exempt from these rules during your lifetime, which makes Roth conversions one of the most powerful planning tools available during early retirement. And qualified charitable distributions let generous retirees satisfy their RMD requirement without increasing their taxable income at all. None of this is about avoiding taxes illegally or finding some kind of loophole. It's about understanding the rules clearly enough to make smart, legal decisions during the specific years when you actually have the most control over your own financial life. The retirees who struggle most with RMDs usually aren't the ones who save too little money. They're often the ones who saved diligently for decades, built impressive account balances, and then never learned the rules for spending that money back down responsibly. The very account that built their wealth over a lifetime becomes the same account that quietly costs them the most in their later years, simply because nobody ever explained how the withdrawal phase of retirement actually works. Saving for retirement was only ever half the equation. Knowing how to withdraw that money wisely is the other half, and it's the half almost nobody teaches you, whether in school, at work, or anywhere else along the way. If this video helped you understand RMDs a little better than you did 15 minutes ago, that's exactly what this channel exists to do. Subscribe for more videos about money, investing, and building wealth.